Hello, good afternoon, everyone. I hope I'm audible. Can someone confirm on the chat if you can hear me? Thank you. So we'll be starting in another 2 minutes, just waiting for a few more participants to join, and then we'll start. All right. So let's begin with the webinar. Good afternoon, everyone. My name is Deepak, and I'm going to be taking this webinar today. I hope you all are as excited as I am because this is going to be the first of a 3 webinar series on understanding how to work with stock market, various kind of terminologies involved, and how we can implement some of the trading strategies and analyze the historical performance of a stock using Python, right? So we'll take it from the very basic to understand what is stock market and what kind of analysis we can perform on the stocks data. Then we will also be talking about what are futures, what are options, what kind of trading strategies can be created on options. And finally, we'll also be looking at if I want to create an automated trading strategy using Python and execute in a broker terminal, then how do I deploy my Python model so that uh, the orders can be taken automatically based on the conditions I have defined, right? So which is nothing but short of algorithmic trading that we will try to explore. So this is something that we will be covering in all the 3 webinars, right? So today it is all about understanding the basic side of it. Before we begin, we have listed a couple of polls for you to answer. So take some time and answer those questions that you see in the poll part of the webinar, right? So you can answer it whenever you want to during the webinar. And let's get started then, right? So the agenda for today is to understand what is stock market, right? Why do we generally work with stock market and what are the benefits of it? The different type of analysis that can be done with the stock market data, be it you are using any platform, right? So there are a lot of different type of analysis that can be done. Then we'll specifically focus on something called as technical analysis, right? And then we'll hit to Python to fetch the historical data using some APIs, and we'll build and backtest a trading strategy, right? So we'll use these technical indicators that we'll understand, and we'll try to build a strategy on top of it and see how it is performing for a given stock in the historical data. Okay. So first of all, understanding about the stock market. So what is stock market to begin with, right? So you can say it's basically where a lot of publicly listed company shares are traded, right? So someone enters into a buy trade, someone is selling their stocks. But it's not just about the stocks of companies. There are a lot of other things that can be traded on the market, like you can see on the screen, like derivatives, like futures and options, bonds, mutual funds, right? ETFs, commodities like gold, silver, crude oil, There can be currencies traded, like let's say how the Indian rupee is compared to the US dollar, right? So let's say the price is around 80 rupees right now. So whether it's going to increase or decrease, you can trade those as well. And then there are some special type of assets that can be traded as well, right? But you can say 99% of the traders end up in trading either equity or derivatives. So either you deal in spot market, which is buying and selling a particular company stock over the exchange, or you deal with the futures and options. So we'll be talking about these the futures and options in our next webinar. Today we'll just focus on the equity part of it. Now, what type of analysis can be performed on the market? So you say there are two type of analysis generally done, right? One is called fundamental analysis, another one is technical analysis, right? So the importance of both is considered when you try to place a trade, right? So in general, what is fundamental analysis? Fundamental analysis refers to understanding the company's performance for which you are interested in buying. So let's suppose I want to buy Reliance shares, right? In hope that these shares will give me some profits over a period of time. So I want to understand first how the company is performing, what's their balance sheet numbers, how much is their assets, how much are their expenses, what was the performance of the company in the last quarter, right? So it is about looking at the financial statements of the company, right? The general economic condition of the country or for that particular industry, and then take a decision whether to buy or sell a company stock or not. So fundamental analysis is about understanding the background of the company stock that you want to purchase or that you want to deal with, right? While most of the traders perform technical analysis. Technical analysis is understanding from the data, like we do in data science. It is understanding the historical patterns and then coming up with a decision when to buy and when to sell. So majority of the trading strategies and for respect, let's say the algorithmic trading part focuses only on the technical analysis part. So you use various kind of helping hands, mathematical calculations on the historical data of the price movement of a company stock. And then you take that decision whether to whether to buy or sell, right? So this kind of technical analysis helps you in, let's say, try and predict if the market is going to go up or go down. So technically, this kind of analysis is what is the backbone of all the, not all, but most of the trading strategies, right? And apart from these two, individually, I can also combine them. So if for a company stock I want to buy, I can look at the fundamental part, understand if they are profitable, what are the order value they have, or any other aspect that can help me in understanding if the company is going to grow. And I can also look at the historical performance of that particular company and see if I'm getting a buy signal based on certain strategies, based on certain calculations, right? What I can also do in apart from fundamental and technical analysis, I can look at the market sentiment, right? So if you know about text mining, how to deal with text data, maybe I can just scrape all the tweets on a regular basis and see if the market sentiment is positive or negative towards a particular stock, right? Many people are buying or selling it because there are a lot of traders who post their views as well as their trades. So what's the majority of the people doing, right? I can capture that sentiment directly through using web scraping and sentiment analysis, and I can include that as well apart from a fundamental and technical analysis. So taking a decision on what strategy to work on and whether we should only focus on technical part of things or we should also look at the fundamental part of things is subjective, right? So many people use the technical analysis. As I said, most of the traders work on technical analysis only, understand when to buy and sell. But there are also people who are long-term investors and dealing in huge amount of money. They also look at the fundamental part, right? So what happens when you invest in a mutual fund, let's say? So you go to any platform, you look at a fund, and you try to create a SIP, which is nothing but a systemic investment plan. So you invest some amount of money every month. So where does that money go? It goes to that fund house where you're investing, and there is a manager in that fund house who's managing your investment along with all the other people who are investing into it. So maybe you're investing, let's say, 1,000 rupee a month or 2,000 rupee a month, but there are millions of people who are doing the same. So the funds can be as high as, let's say, 1,000 crores. So the responsibility of the manager is to generate a consistent return for every investor that has invested in that fund. So they are not looking for a return of 15 to 20% a year or 30% a year. So they just want to be at the benchmark returns of the indices. So in other way, you are investing in something, but you're not worried, or you're not doing trading on your own. You're just saying, okay, this is my money, keep that money and help me grow it. And the fund manager takes all that money and puts it into the market based on your preferences, whether you want to invest in equity, whether you want to invest in debt, bonds, commodities. So there are different kind of funds that invest in different channels. So accordingly, the money is invested into the market and then the returns are accumulated. Those funds, when you talk about crores of money, that is where you cannot just simply work on technical analysis. You need to identify stocks where to invest based on fundamental analysis too, because you don't want to invest in something where your probability of losses is a little higher and you might end up in a loss, so that it's not just your loss, it's the loss of the other people who are invested in you, right? So we will try to focus mostly on the technical analysis part today, but as I said, fundamental analysis is equally important for it, right? So for the technical analysis, what does it involve? There are a lot of things that we can understand within this section, right? So you can say it is understanding about the price patterns, right? Popularly known as price action analysis. How the price movement is for a particular stock, right? Whether it is going up, whether it is going down. So you can say it's sort of identifying trends and patterns. Then you have a lot of indicators and oscillators. This is one of the key components of technical analysis, right? So indicators are some mathematical calculations on the basis of which you try to identify the position in the market, and then you accordingly try to buy and sell an asset, right? Then you have support and resistance levels. These are kind of price points where the price try to steady itself. So let's suppose market is going down continuously. So you can say support is where the market will try to stabilize itself. Generally, it is talked about level of the market where the price is not going to break that easily, right? Resistance is similarly on the upper side. So if the price is going up, there will be a point where the price will struggle to go up further. That's a resistance level. So based on the historical prices, we can draw the support and resistance levels, and many people just simply go and buy at the support level and sell at the resistance levels. That's also like one of the most common trading strategies that beginners use, right? Then there are many other technical analysis that can be done, right? So which we'll be covering in detail in our course, but for today's webinar, we will just be talking about these indicators and oscillators and how they can be useful in order to create a strategy, and we'll try to implement them in Python, right? So for these technical indicators, we can say there are mostly four different type of indicators. While this is not the entire list, I'll share a, a resource where you can understand about all these indicators towards the end. But you can say there are four broad categories of technical indicators, these calculations that we generally do on any stock price. So one is volume based indicator, where most of the people use a money flow index or a volume weighted average price. Then there are trend based indicators, where people use moving averages, right? Moving average is a key component of how you analyze time series data. And then there is something called a moving average convergence and divergence. right? So these are the popular indicators under the trend-based indicators. Then you have some volatility-based indicators, that how volatile the market is, how frequently the price is fluctuating. Is it happening that within 5 minutes the price is going, let's say, 10 points up, 15 points down, or is it steady that it is ranging within a certain units, right? So volatility is very important in the market, especially when you're a short-term trader. And you can measure this volatility and create some strategies using a volatility index, which is called VIX, right? So just like in Indian stock market, you can say there are two major exchanges. One is called Nifty, right? And one is called Sensex. So Nifty is represented by popularly says Nifty 50, which is a combination of 50 companies that has the highest market capital. And then you have Sensex, which is represented by BSE, which is Bombay Stock Exchange. VIX is another, you can say, sort of exchange where you understand the volatility of it. Generally, it is said if the VIX is more than 15 or 17, then the market is very volatile. But if it is less than 15, the market is not volatile, right? So you can simply go to Google and type India VIX, right? If you go to Google and type India VIX, you'll get a number there. So let me try to show you that number. Just a second. So this is what India VIX looks like, right? So you just say India VIX, you get a number here. This number helps you understand the volatility part, that how volatile the market is. So if this number crosses 15 and above, then you can say the market is really volatile, and that is when people prefer to trade in the futures and options. But if the market is not volatile, that means the movements is not going to be very fast. Then people does not really prefer to trade, right? So this is like one of the trading strategies. What I'm talking about is subjective. It can differ from person to person, but these are some practices that are being followed by many people in the industry, right? So that's what we can say. Now, coming to the other type of indicators, we talked about the technical analysis. One second. We talked about the different kind of indicators here, right? So volatility based, momentum based, and all. So today for creating the trading strategy, we will use a trend based indicator like moving average, see how this can be useful in creating some trades, and we'll see if that is profitable or not. And we'll also be looking at a momentum based indicator, which is a relative strength index, or RSI, right? So RSI is an indicator that helps us in understanding overbought and oversold positions. So if the RSI is below a certain value, that means many people have sold the positions, they have exited the market, which means there could be a potential buying opportunity there. And if the RSI is above a certain limit, that means it's an overbought position. Many people have bought it. Now there could be a possibility that the profit booking will be done, right? So it's a good opportunity to sell because it might not extend further. So every indicator have their own purpose and use, right? There are many indicators that can be used. I can show you about 50 to 60 different indicators that can be applied, and you can create a trading strategy based on any of them. While today we are mostly going to look at trend-based indicator of moving average, a volatility-based indicator of Bollinger Bands, and a momentum-based indicator of RSI, right? So we'll try to use these three different indicators from the three categories and see how they can be used. So with that basic understanding of how stock market works, what are the different type of analysis and technical indicators we are going to use, let's head to Python and see how to build a trading strategy using these indicators. And first of all, how to fetch the data live from the market. Okay. So let me share the Jupyter notebook. So let's first understand what are the different libraries that can be used in order to work with stock market data in Python. Right? So for those who understand Python programming would know these are some of the basic libraries that we generally use for data manipulation and visualization, which is NumPy, Pandas, Matplotlib, Seaborn, right? Now, one specific library, which is called Yahoo Finance, this is what we are going to use in order to fetch the data real time. In order to work with this library, you have to first install it. The installation process is pretty simple. You just say pip install yfinance and it will be installed, right? And to generate data based on those technical indicators, I'm going to use these two libraries called TA, which is nothing but technical analysis, and pandas underscore TA. So pandas supported technical indicators. So we can use any of the two libraries in order to generate the data based on those technical indicators we just talked about, and yfinance to generate the pricing data of a given equity. Not just about stocks, but yfinance can help you generate data for any asset, for any index around the world. It's not just about the Indian market, right? So from Yahoo Finance, you can actually fetch any data for stocks, for commodities, for currencies, for crypto, and whatnot. So it gives you the prices for everything. And you can fetch the data at any interval you want, right? So when you want to analyze any stock prices, the most important thing is, are you interested in doing a short-term trading, like let's say intraday trading, where you're buying and selling on the same day? Or are you a positional trader where you're buying certain things and you expect that to give a higher target, or you hold the trade for a longer duration, maybe let's say a month, 2 months, 6 months, or a year? So depending upon that, you decide the time frame on which you will be analyzing these stocks. For intraday trading, for someone who's buying and selling on the same day, maybe a shorter duration data would work. Data which is available on 5 minutes or 15 minutes. But for someone who's going to take a positional trade and hold for a longer duration, they probably want to understand the trend a little better and may have to look at a higher duration time frame, like 1 hour or one day. Today, we are going to fetch data on a daily basis, right? So using these libraries, we are going to fetch data, for example, let's say IndusInd Bank today. We are fetching the data from the start of financial year 2020, 1st of April, till yesterday's closing price, right? So we are using the Yahoo Finance YF, using the function download, define the script. This is how it is defined in Yahoo Finance, right? For all the stocks which are listed in Nifty 50, it's an extension, a suffix at the end of .ns. So when you execute this, it will fetch you the price of the stock immediately. So you can see how fast it was. It just took under a second to connect Python to the Yahoo Finance database. And based on the query, it got us the data. So we did not have to read any files here. I was able to read the data directly using this library for any script that I want, whether it is, let's say, IndusInd Bank, or if I want to look at, let's say, some other script, like, let's say, State Bank. So I can just simply say SBI and it will give me the data of State Bank of India. So it depends what stock you want to work with. Accordingly, you'll fetch the prices. And the output here you can see is on a daily basis, right? The data is available till yesterday. What was the opening price of the stock yesterday? What was the high? What was the low? What was the closing price? And what was the adjusted close? How many shares were traded on the exchange on that given day, right? So you can see the open and the high are same. That means the stock opened at a price point and then it just declined from there, and finally closing almost about 34 points below. Now, in order to create any strategies, we can use any of these variables. If I want to build, let's say, a machine learning model to do it, right? Whether the stock is going to go up or down in a particular day, we can predict that using time series. We can predict that using a general classification model like a random forest or ensembles, like a boosting method, or I can even build a neural network to do that. But today we are not going to discuss any predictive modeling here. We will just talk this closing price. What was the closing price of the stock on a given day? And we'll try to analyze that only, right? So if you look at the trend of the prices for almost about the 3 years worth of data that we have, in the beginning of the time period that we've chosen from the 1st of April 2020, the price was slightly below 400, which has now crossed 1400. So in the last 3 years, the price has gone 3 times, right? So if I want to use a technical indicator, which was, let's suppose I want to start with a trend based indicator, understand the trend in the market. Well, those who know about time series, they can understand and say, okay, it looks like an upward trend, because from where the series started and where it is ending, we see there is an increase in price. So which means that it's on an upward trend. But it is not always upward trend, right? Because time and again, we see the price declines too. So we want to understand if this movement up and down can help me in defining when to buy and when to sell. So for a trend based indicator, we are just going to use a simple moving average, or we can also look at an exponential moving average, right? The difference between a simple and exponential moving average is that a simple moving average is giving equal weight to all the time periods involved. So if let's suppose I'm calculating a simple moving average of last 20 days. So for the last 20 days, I'm giving all of the prices an equal weight, 5% weight to each of the value. But when we talk about an exponential moving average, it is about giving a higher weight to the most recent observation and a lower weight to the past observations, right? And how does a weight is decided? It's decided on the basis of something called as alpha, which is defined as 2 divided by n plus 1. When it comes to understanding this exponential moving average, alpha is the weightage that I want to give to the most recent observation. And that alpha is defined as 2 divided by n minus 1. So if I'm taking a 200-day moving average, 2 divided by 201, whatever is the alpha, that's the weight I'm going to give the most recent observation. And then it is 1 minus alpha t minus 1, 1 minus alpha square t minus 2, 1 minus alpha cube t minus 3, right? So it's a formula based calculation. And we don't have to do all these calculation manually, because we can simply use some Python functions like rolling, which will give me a simple moving average. So I am calculating a simple moving average of the last 20 days. I'm calculating a simple moving average of the last 50 days, as well as I'm calculating an exponential moving average of the last 200 days, right? So we are just trying to understand how moving averages can help us in understanding the trend of the market. And as we say, trend is our best friend when we talk about trading. So if you place a trade with the trend, you are most likely to be profitable. But if you go against the trend, you will end up in losses most of the times. So if I go ahead and create these simple moving averages, right? So for every day, we create 3 new information, which is a 20-day moving average, a 50-day moving average, and a 200-day exponential moving average. Now, this is where the decision of the number of days that we have to calculate an average on also differs, right? So if I'm a short-term trader, I might not be interested in looking at a very high duration of like 200 days. Maybe I'll just simply look at 20 days or 10 days or 15 days, right? If I'm a long-term and a positional trader, then I probably want to look at a higher number because I want to understand the trend properly so that I can take a trade and leave it open for a longer duration. So the time frames that we decide for moving averages also differs based on your trading aptitude. So if you're a short-term trader, you will select a shorter moving average window. If you're a long-term trader, maybe you will select a long-term or a higher frequency moving average, right? So once these are generated, let's go ahead and visualize them. So you can say this is how the chart looks like for the closing price of the stock, which is highlighted in the blue line. Then you have a 20 moving average, which is the green line, a 50 moving average, which is the red line, and a 200-day exponential moving average, which is nothing but the purple line. Now, when you see all these lines together, do you see any opportunity to buy or sell? Right? Let me know in the chat window. When I'm visualizing all these lines together, does it help you in identifying any trade opportunities? We are simply plotting the moving averages that we've calculated for a certain number of days in the past. So we are looking at a simple average of 20 days, 50 days, and an exponential moving average of 200 days. So one of the strategies that generally works on moving averages is called crossover strategies. We define a crossover. As the name suggests, crossover means when one line crosses the other. So wherever we see an intersection of these lines, wherever one line is intersecting the other, then we either buy or sell. Here, we are trying to define a simple crossover strategy that when not 9, let me just change this. When the 20 SMA crosses above the 50 SMA, I'm going to go buy. And when the 20 SMA crosses below the 50 SMA, I'm going to go sell. So here, whenever the green line crosses the red line on the upper side, we are going to go buy. And whenever it crosses below, we will sell our position. So if I zoom this chart, let's say I zoom this window a little so that you can clearly see it. Are you able to identify where it is intersecting? So let's suppose we look at this particular area, right? Green is intersecting the red on the upper side, this area, right? So at this position on, let's say around September 2020 or October 2020, I have my first trade and it is intersecting again at this position in close to the May month of 2021. So you can see the price movement. The buy position was close to 600 rupees and the sell position was approximately around 100 rupees. So this resulted in a profit of almost about 400 units. So if I would have bought a single share, it would have given me approximately around 400 rupees per share profit. And then you can visualize the other areas too, right? So let's try to implement that using Python programming. Let's create some functions and understand where we should have bought, where we should have sold. So I'm creating a copy of the data frame just in case I need the original one. We are creating a signal saying wherever the 20 SMA is greater than the 50 SMA, I'll buy represented by 1, right? That is, I'm going to add my position. And then I'm just going to look at the difference from one position to the other. So if I'm saying that one day I'm buying, the other day also I'm buying, the third day I'm also buying. So if I'm generating a buy signal continuously, then I am just going to take the first position, right? So here, if I look at this particular day, the price was above. So for that day, it generates a signal of 1. Now the next day, the price is again above the red line. So that will again generate a signal to buy. Then the next day will also generate a signal to buy, and it will keep generating a signal to buy till the time the green line is above the red line. But should I buy at all the signals? Should I buy at every signal? No, I will only buy on the first signal till the reversal. So which is why we are taking a difference, because the difference will then be 0, right? So if I'm generating 1, 1, 1, 1 every day, the difference of 1 and 1 will be 0. That means I'm not taking a trade on that day. Whenever I'm taking a trade, it is the first one and not all the positions, right? So we are just looking at the first day when the signal was generated, right? As you can see here, on the last part here, the green has crossed the red line, 20 SMA has crossed the 50 SMA in the month of May, and it has not crossed back yet. That means from the month of May, this stock is going up. If someone has bought here, which is around, let's say 1,100 rupees, right now the stock is at 1,400 and there is no sell signal yet. So which is why you can see that the signal says 1 because the green line is always above the red line. But I'm not buying on those days because I've already bought it on the first day, right? So that's what this difference does here. Now, if I go ahead and just visualize those positions that we have taken, so you can see here with the help of these green and the red triangles, you should be able to spot that this is a green triangle. That means at this position, we should have bought, and at this position, we should have exited. So we are buying close to 400, we are selling close to 1,000. Then it's again giving a signal to buy at close to 900 and giving a signal to sell close to about 950, right? So another buy, sell, another buy, sell, buy, sell, buy, sell. So it will keep giving you those signals. Whenever the lines crosses, you buy, and it crosses again, you sell. A simple but effective strategy. Might work, might not work, because in stock market, it is not guaranteed that every time a single strategy is going to make money. But you have to experiment with it a lot, depending upon the market condition, depending upon the asset class you're trading, depending upon the condition of the market. Some strategies might work really well, some might not work well, right? So even if in the historical data something is working well, it might not work well in the future data, right? Because the market is very dynamic, it keeps changing. So nothing is fixed, but it is about experimentation. That what kind of moving averages you are taking. Are you taking a simple moving average or an exponential moving average? Are you taking a shorter window or are you taking a longer window for moving averages, right? Are you looking at the time frame of 5 minutes or are you looking at a time frame of one day? Right now, the data that we are looking at is a daily data. So which means the price is available only for a day. If I want to be, let's say, an intraday trader, I want to generate a trade within the day and close it on the same day, then I might be looking at a smaller time frame, maybe let's say 1 minute or 3 minutes or 5 minutes, and then accordingly place a trade, right? So this is how a trend-based indicator, a simple moving average, can help us in identifying some trading opportunities. Now we can replicate this for any stock of our choice. We looked at IndusInd Bank for an example, but I can replicate it for any stock that we are interested in. I can even download from Yahoo Finance data for, let's say, multiple stocks together, and then this strategy. So it is about understanding the trend of the market, how the market is going up or down, right? And placing a trade according to the trend. That's what the moving average is to, right? So here we can optimize the strategy a little more. We can say we are just looking at a trade between SMA 20 and SMA 50. Why not also use EMA 200? So maybe we can say when green crosses the red line, when the 20 SMA is above the 50 SMA and the closing price is also above 200 EMA, then only I'm going to buy. So I can add additional condition there. So which means, let's say it is crossing here and here. So whenever the price crosses both the lines, then only I'm going to buy. Right? So I can add an additional condition like that. So you can define as many conditions as you want, depending on the moving averages, the time frame of the chart, and the window of the average. There is a lot of scope to experiment and to create a strategy accordingly. Right? Now, this is something that we can generally do on a normal chart as well. If you have a broker account, you can simply draw a moving average using any broker terminal. So you don't really need to go to Python to do this. But we are just understanding how Python can be helpful here is because from a broker terminal, I have to identify those crossovers manually and place a trade manually, right? Whenever the line crosses. With Python, what is the benefit is if I've coded the strategy, I can go ahead and deploy it, which means I do not have to place a manual trade. Once I have coded the strategy, I can deploy this Python notebook or the model that we've created, connect it to a broker terminal using an API. So whenever a signal is generated, it will automatically place a trade for me. So I don't have to do these things manually, right? So that's the benefit of using a coding platform or a third-party tool to create a strategy and automating it. But how to do that is something that we will be looking at in our third webinar. Today, it is just about understanding how to use Python for creating these indicators and building strategies. Right. I see one of the questions. Can you point to an example where this strategy 20 versus 50 MA will not work? Yes, definitely. So we can say probably at this area, the profit is too low, but before giving you a profit, it is also going a little down. That means there is a probability that it can hit a stop loss. Whenever you are placing a trade, it's always advisable you have a defined stop loss and a target profit in your mind. So let's say I'm keeping a stop loss of 5% or 7%, depending upon my risk aptitude, right? So how much of risk I want to take on my capital. I want a risk to reward ratio of at least 1 to 3 or 1 to 4 if I'm a positional trader. So if I'm taking a risk of 5%, I want to gain at least 20% from the stock. So before you get the target, there could be chances where the stock might hit a stop loss. Like in this case, you're buying at this position, but the stock is going down. So there is a possibility that it might hit your stop loss here. So you'll not end up in a profit because you're exiting the trade in losses. Right? So same way, there can be a lot of chances where before hitting the target, you might also end up hitting a stop loss. So while this looks like a very good opportunity where I'm looking at buy and sell and there is a good profit shown, but under the hood, when you try to place it in real life environment, then things are a little different, right? So you have to include a lot of other factors when you're placing these trades, right? So this was about moving average, which was a trend based indicator. Now let's talk about a volatility based indicator, which is called as Bollinger Band. Bollinger Band is very simple and it works on the principle of normal distribution of data, right? In statistics, you might have learned what is normal distribution and what are the benefits? So a Bollinger Band basically is going to look like this, right? Let me just simply plot a Bollinger Band that this is going to look like this, right? I'll come to how it has been created. Let's first understand the plot. So there are 4 lines here. One says the closing price of the stock, which is highlighted in the purple line. Then you have a Bollinger Band moving average, which is the green line. This is a 20-day moving average by default, right? So a 20-day moving average, just to understand the trend on a short-term basis, and the Bollinger Band low and high, which is highlighted by the blue and the red lines, is nothing but 2 standard deviation of the movement of the average value. So we are taking the price data, whatever was the closing price of the stock. We are calculating the 20-day moving average. And then we are looking at 2 standard deviation from that mean on the upper side and on the lower side. Because based on the principle of normal distribution, we know that within 2 standard deviation, I have 95% of the variations in my data. So there is an empirical rule which says within 2 standard deviation from the mean, you will have 95% of the variations. And even if the distribution is not normal, within 2 standard deviation, you'll still have about 90% variation captured based on the Chebyshev rule. So if I'm able to capture 90% of the variations with this strategy, that means I'm likely to make a slightly better profit, right? I will have a slightly higher probability of making profits than losses. So volatility is, as I explained earlier, it is about understanding the frequent movements, right? So the market is fluctuating a lot. The price are increasing and decreasing very frequently. We say the market is volatile. And that is where Bollinger Bands works really well. It's a simple concept that if the price of the stock goes above the moving average, I will buy. And if the price of the stock goes below the moving average, I'll sell. It is also known as a mean reversion strategy. Mean reversion means that the price will always revert to the mean. Once the market is volatile, if the prices are going up or going down, it always tends to come to the mean value. So if the price is going up, I will buy, and my target will be the 2 standard deviation above it. And my stop loss will be the 2 standard deviation below it. Similarly, if the line is crossing, the price is crossing the average below, I will sell with a target of the 2 standard deviation again. So this way, if you keep doing that, it is like the moving average. You will get a lot of buying and selling opportunities, and you can cash in a few of them. Take an advantage of the market. So Bollinger Band is a volatility based indicator which helps us in drawing these lines, which is a 20-day moving average plus 2 standard deviation minus 2 standard deviation. And to generate these data points, we are using the TA library, which we imported earlier, the technical analysis. From the technical analysis library, we are looking at a volatility based indicator, a Bollinger Band, where the value is the adjusted closing price with a 20-day moving average and 2 standard deviation above and below it. Right? So that gives us these indicators, these lines. So a 20-day moving average was calculated automatically along with 2 standard deviation. And if I look at all the indicators that are available under this technical analysis library, then you can find there are about 95 values, right? So there are a lot of volume based indicators, right? Remember I talked about 4 categories of indicators. There are some volume based indicators. So you can see there are so many of them calculated automatically. There are a few volatility based indicators. So there are so many volatility based indicators calculated automatically. There are some trend based indicators. So you can see there are so many of the trend based indicators, the values has been calculated automatically. And there are some momentum based indicators which has been calculated automatically, out of which RSI is another indicator that can be very useful if I want to trade based on the momentum of stocks, right? Whether the stock has been sold by maximum traders or bought by maximum traders. Accordingly, I'll go with the flow. If I want to use any of the indicators, it is readily available in Python. I don't have to do any manual calculation. All I have to do is install this library TA, and within this library, choose which indicator I want to work on, whether I want to work on trend, volume, volatility, or momentum. Or I want to work with a combination of these indicators too. So I can simply say for this trading strategy that we try to explain using simple moving average, I can also include a momentum based indicator of RSI, that once the line crosses and if the RSI value is below 20, then only I am buying, right? So RSI is a calculation which is called as relative strength index. It gives you the strength of the underlying asset. So if it is below a certain number, generally 20, then it's an oversold position. What oversold means? So RSI is calculated by default on the last 14 days prices, right? So it's a ratio of the average gain or loss in the last 14 days. So if in the last 14 days there are more people who have sold, or you can say the market is heading downwards, then the RSI value is going to be lower. If there are many people who are buying it, then the RSI value is going to be higher. So when the RSI value of the last 14 days is less than 20 and the moving average of 20 crosses 50, then only I'm going to buy. And at the opposite, when the RSI goes above 80, I'm going to sell. Or let's say above 70, I'm going to sell. So you can take a decision on many indicators. There can be many trading strategies that we will keep discussing as time progresses, as we do more and more webinars. But for today, it was just about the understanding of how these technical indicators can be useful, understand how Python can be used in order to build these strategies, right? So in our next webinar, we'll be talking about how to work with options data, and with options, how do we create some strategies, backtest them, explore a few more platforms where we can create these option strategies and test them, right? Not necessarily Python, but we'll also be exploring a couple of other platforms. And we'll also be looking at how to do that in Python too. Right. So let's go to the questions that you might have. Right. So I see a lot of questions that you guys have posted. Okay. So what do you mean by BN? Okay, it has been answered, I guess. How does bonus and splitting of shares work in such analysis? So that's the fundamental analysis part of the stock, the bonus and splitting of shares. It is just about uh, understanding the company's actions and increasing the number of shares you have. Maybe the stock price will reduce, so it will definitely impact the technical side of things. So whenever there is a split of share, you can say that the price almost reduces by half, right? So you try to create now new models from here onwards. You can't really take a historical data of something which was, let's say, trading at 500 and after split it went to 200. You will not get good results in that cases. You can fit models like neural networks in such a scenario, right? So I'll show you the application of machine learning in the next session when we talk about options and futures, and there you'll understand in situations also like COVID, where market was down by more than 50%, how does a neural network understand these patterns and give you more relevant outcomes. Is it possible to deploy these strategies without a predictive model? Yes. So I just explained, you create those signals, when to buy, when to sell, and you can deploy a model which can directly place a trade. So there's no involvement of predictive models here. Enjoying much. Will you kindly have a word on super trend? Okay, Sandeep, not today, but I've noted your request. We'll try to include super trend next time. Super trend is something which is not available in Python to use. So we'll probably have to use some other platforms like TradingView. Possible to get the traded volume and the delivery volume from this library? Not from this library, Manoj. Not, Yahoo Finance will not give you this data, but it is only going to give you the volume traded, number of shares. But there is another library which is called NACDT. So I'll probably share a notebook as a part of a follow up to this session, to this webinar. It will include that NACDT as well, right? So you can use that library and fetch the number of shares traded on a particular stock or an exchange, and it will also give you how much of that was intraday, how much of that was delivery. So it has a lot of other details within it. So I guess we can wrap up the webinar here. Thank you so much for joining today's webinar. I hope it was slightly useful because it was just basic. So maybe those who did not had any knowledge about stock market got to know about something. And for those who wanted to know how Python can be used, you got a little bit of understanding of how Python works with stock market data, right? So I'll have our second webinar on the 19th of August, which is the next Saturday, same time, 2 p.m. And there we'll understand about the futures and options and trading strategies related to it. So you will get an option to register for that webinar shortly. So register for it, attend, and we'll do such webinars with all of your participation, and keep following us, right? So thank you so much. Let's wrap up the day here. Take care. Bye-bye.